Good afternoon. This is Don Rissmiller, your host and Chairman Emeritus for the Global Interdependence Center. On behalf of everyone at the GIC, welcome to today's executive briefing. Since launching the executive briefing series last March, the GIC has explored many facets of the COVID-19 pandemic. The goal of these webinars is to provide a neutral, unbiased forum. Through the remainder of 2020, GIC will continue to deliver a combination of fact-based insights regarding the pandemic, as well as thought leadership on key topics, including monetary policy, geopolitics, trade, climate change, and artificial intelligence. As a reminder, today's event is being recorded. The replay and the slides will be available on the GIC website later today. Now, I am delighted to introduce our speaker, President Jim Bullard. Jim Bullard is the President and CEO of the Federal Reserve Bank of St. Louis. In that role, he is a participant on the Federal Reserve's Federal Open Market Committee, FOMC, which meets regularly to set the direction of U.S. monetary policy. He also oversees the Federal Reserve's 8th District, including activities at the St. Louis headquarters and its branches in Little Rock, Louisville, and Memphis. A noted economist and policymaker, Bullard makes Fed transparency and dialogue a priority on the international and national stage, as well as on Main Street. Bullard is a co-editor of the Journal of Economic Dynamics and Control and a member of the Central Bank Research Association's Senior Council. He is an honorary professor of economics at Washington University in St. Louis. A native of Forest Lake, Minnesota, Bullard received his doctorate in economics from Indiana University in Bloomington. With that, we'll turn it over to our presenter. Welcome, President Bullard.
Well, thank you, Don, and thank you to the GIC for sponsoring this event. It's a pleasure to be here. I'm going to talk about some of the themes I like to hit on in thinking about COVID and how the economy is evolving in reaction to COVID. So I've called it COVID-19 and the U.S. economy, progress on health and incomes. I do think we're making progress both on handling the disease and on the economy, and I'll lay out my arguments as we go forward here. So if we go to the next slide, and the next slide, this will be the introduction. So the main themes that I'm going to talk about here, I'll give you some charts on why I think there's been substantial progress in handling the disease. We are no longer in the initial phase where we didn't know very much about the disease, and we now know a lot more about it and have ways to mitigate its effects. I'll talk also about how the U.S. macroeconomic news has surprised dramatically to the upside during the May, June, July, August timeframe and into September here, and even today, I guess, a pretty good housing report. So this is all adding up to outsized growth in the U.S. economy in the third quarter. I'll talk about that. I do expect this rebound to continue into the fourth quarter and into the first half of next year. Not at the same pace as the third quarter, but still at a very rapid pace and certainly an above trend pace through the first half of next year. I think the simplest theory is that the obvious thing is happening where businesses are learning to adapt to the new mortality risk that's in the economy using simple technology pioneered by the essential services group that had to stay open during the first part of the pandemic. I'll also talk about U.S. monetary and fiscal policy, which I think have been exceptionally effective, at least during the first phase of the pandemic here. But I also think that fiscal policy was designed for a larger shock than the one we've actually experienced, and I'll talk about that. And it wouldn't be complete unless I mention and stress that downside risk remains substantial. We're going to have to be very careful, continue to be very careful going forward, both on the health side and the economic side, in order to come out of this as well as we can. So I do acknowledge downside risks, even though I'm being more bullish than maybe other commentators on the U.S. economy. So let's get started and go to the next slide. So this whole section will be about substantial progress and health outcomes. We'll go from here. So I think that there's been a lot of progress since the initial phases of the crisis. When a pandemic comes along, of course, it's very rapidly moving. Things happen at an exponential pace. You don't have a lot of information about the disease. So that's a very different era than once you have some data, or quite a bit of data now globally about the disease. You start to learn a lot about it. That's probably my biggest theme of, about both the health response and the economic response. Daily fatalities per 100,000 population have declined substantially from peak levels in March and April, both in the US and Europe. For Asia and the Pacific countries, they're continuing to report daily fatalities per 100,000 that are order of magnitude lower. And I think this is a key issue for understanding this disease. I'll show you a picture in just a minute, but a simple theory would be that there was more natural immunity there than there is in the other parts of the world, just because they've had coronavirus issues in the past, possibly ones that we don't know about very much. So I think there's more natural immunity in Asia, and they've had more success because of that. But from a macroeconomic perspective, this suggests that our main areas of production are well past the initial phase of the crisis, and they're likely to continue to increase economic activity, but under new safety protocols that wouldn't have been around before the pandemic. For those that are interested, I've got a footnote here on the Atkinson-Kopecky-Za paper, which I'd recommend. They're taking all the data on COVID and fatalities around the world and trying to summarize what we know as of now based on the data. Their conclusion is that given all these different jurisdictions all around the world that reacted in all kinds of different ways, you can still pretty clearly characterize how the pandemic progressed in each of these areas, and it has a pretty predictable pattern. So I would say that that's their main stylized fact that comes out of that paper. But those that are interested can check that out. Let's go to the next slide. So here's my key picture on substantial progress. This is fatalities per 100,000. So we're normalizing in order to get the size of the countries right. That's something I've been frustrated with over the reporting in this in the last 6 months. Also, I put France, Germany, Italy, Spain, and the UK together and called that Europe. That's the gold line in this picture. Those are the main economies in Europe, and so I want to look at them as a group. And like the US, those 5 countries had an uneven response to the crisis. And also like the US, the population is in the low 300 million range. And like us, they are the economic engine of that part of the world, and certainly on par with the US as far as an economic action. Asia and Pacific is less well defined. You can barely see it on this chart. It's basically a zero line across the bottom. So I would take 3 things from this picture. It goes from March 2020 up until the present. Fatalities are reported with something of a lag, so you got to keep that in mind. It's not completely up to date, but it is into September here. So Europe, I would say, was hit the hardest based on this picture. We've got that marked there. That's a 1. So that's 1 death per 100,000 or 10 deaths per million on a 7-day average in Europe at the peak. US peak was somewhat lower, so we were hit somewhat less hard than Europe, but when you go out to the right, you see that the US has lingering effects, so we've got more persistent effects in the US. Some people say that's because the disease spread across the country in a different way than it did in Europe, so maybe that's part of what happened here. The blue line, though, is ticking down in this picture, so you got a 0.2 there or so at the end. That's 2 per million per day. That's how you should think about that. 2 deaths per million per day. And Europe, very low now on the right-hand side of this chart, but perhaps coming up very, very slightly. So that's something obviously markets are keeping an eye on here. And then the green line here, East Asia and Pacific, very large area, which includes China. Nothing like the experience in the US and Europe. And this is something I think we have to get our heads around. Why is that? Why is that green line so low on this scale compared to US and Europe? I'm suggesting natural immunity, but I'm certainly no medical expert, but that would be the first thing you might think of. I think a lot of people have ideas about second waves. If you have an idea about a second wave, I think it has to be that this picture will go up to the same level that it is on the right-hand side of the scale or higher. So Europe would have to go over a 1 here on this scale. US would have to go over a 0.65 or something. Then you'd be back in the same kind of situation that you were in March and April. It doesn't look like the data is going in that direction. And we know there's so much information about the disease. I think that's unlikely to happen. I think when you do have you have other things going on, better therapeutics, and people are naturally taking their own precautions if they're in a vulnerable group. So you're unlikely to get the kinds of peaks that you have on the left-hand side of this picture to occur again, given all the endogenous responses going on in the economy. So my baseline does not have a second wave occurring. Let's go to the next slide. Here's a lot of people say, well, the US has not done a good job in responding. This is a stringency index from the University of Oxford Public Policy School. We've got several countries listed here. This goes from January of this year, when there wouldn't have been any restrictions in place, all the way up to the present. The US is the dark blue line in this picture. You know, I'm not seeing it. It's true that the stringency, of course, went way up in March, and it has come down somewhat according to these guys who are trying to measure this. But it hasn't come down all that much. And other countries that get high marks for handling the health part of the crisis, Germany, which is the dotted line here, and Japan, which is the lighter dotted line, which is the lowest line in this picture on the right-hand side. They actually are less stringent than the US or China in this picture. So I don't really think it's necessarily about the public health part. I think the stringencies that are in place are the right ones for now. I'm going to emphasize that the private sector is the one that's reacting to this crisis, and it's the private sector that's adjusting so well, and that's bringing more and more production back online, and that's why the U.S. economy is going to be growing extremely rapidly in the third quarter and probably beyond that. So let's go to the next slide. Sorry, the previous slide. I would just say one other thing about the stringency. It suggests that the U.S. actually has some upside here, right? You could relax restrictions to the level of Japan or Germany here. Presumably you'd improve the economy and you'd still be able to get great health outcomes. We're not doing that right now. It doesn't look like according to this picture, but it sounds like that's something that would potentially be out there in the future. All right. Okay, so there's been a lot of upside surprise in US macro data. I think a lot of listeners here probably know that, but let's go to the next slide. I think April 2020 will prove to be the lowest point of the crisis. If we were dating the recession today, it would probably be just March and April, which would be an extremely short recession by US macroeconomic standards. The recession dating committee is known to behave at a very tortoise-like pace, so I don't think they're going to be naming the dating of the recession here for quite a while. But if you were doing it, it would be the months where activity actually declined, which are those months. And since then, we've been expanding on all dimensions, or many dimensions, probably all dimensions. The City Economic Surprise Index indicates substantial upside surprise. We're going to see that chart here in just a second. Employment has rebounded more rapidly than expected. That supports the idea and the intuition that everybody has, I think. A lot of these layoffs were temporary as businesses temporarily shut down, were asked to shut down to invest in the national health. Workers were asked to stay home to invest in the national health. We tried to compensate those workers. And then as they learned how to operate their business in a safe way that was consistent with what we know about the disease, they started drifting back toward work, and they actually came back at a fairly fast pace. Again, as I was saying, third quarter GDP growth accordingly is projected to show substantial expansion. And I'll just put a provocative thought in here. There's actually an outside chance that US GDP could reach the 2019 average level by the end of 2020. You could call that a form of full recovery. I'll have a slide on that. You guys will love that. So let's go to the next slide. Next slide, please. I'm not seeing the next slide. Are we trying to go there? There we go. Great. Data releases surprise to the upside. This is the Citigroup Economic Surprise Index. I've charted this all the way back to January 2015, just to give you an idea of what we're talking about here. I might have a little bit different interpretation of this chart than some people. This index is measuring what the data release said versus what markets expected on the eve of the data release. And you can see that the scale is kind of a plus or minus 50 is a typical reading. 0 means that the markets weren't surprised at all by the incoming data. But look at the far right-hand side of this chart. You go up to a 250, a 150, a 250, so it's way out compared to what the normal surprises would be. And I'm taking that as an indication of the forecasted community kind of misreading the pandemic shock. It's not surprising, pandemics don't occur every day, but they're misreading the pandemic shock and you know, predicting that things will take longer, that it's going to be like the global financial crisis, it's going to be long, drawn out, and that hasn't been the case. Instead, you've got things coming back much faster than what the forecasting community expected, and that shows up in this chart as these outside data surprises, one right after another over recent months. So we'll see if this continues to go on in the weeks and months ahead, but I think that this has been very telling in the first phase of this crisis. Next slide, please. This picture also attempts to get at this idea about how different this shock is compared to the shock in 2007 to 2009, which was a global financial crisis originating in the US and then reverberating around the world. In that crisis, the height of unemployment was 10%, and that occurred in October 2009. So that blue line there starts at that peak of 10% and then shows you 0. It's all normalized to 0, and then shows you how much the unemployment rate declined as you go to the right in the picture from that 10% peak. And you have to go way out to the right-hand side of this picture, 24 months after the peak in the last crisis, and you had only reduced the unemployment rate by 1.2 percentage points. So the unemployment rate declined very, very slowly after the last crisis, excruciatingly slow improvement in labor markets last time around. So my idea is that what the forecasting community is putting too much weight on that experience, on the blue line there. The blue chip forecasts as of April of this year are the gray dotted line there. So they were expecting some improvement in labor markets. And then the gold line and the I can't tell if that's green, I guess, line show what has actually happened in the 4 months since the peak unemployment rate. And the unemployment rate has just come down spectacularly fast, 6 percentage points according to the gold line. And if you're willing to make adjustments for other factors that are going on in the measurement of unemployment that the BLS has talked about, you get the green line there, a whopping 10 percentage point decline there in the unemployment rate in just 4 months. Now, this makes sense if you think about what the shock is. The shock is that we had a pandemic come upon us. We asked people to go home to invest in the national health. We compensated them through the unemployment insurance program. We put plenty of resources in that program through fiscal policy. But as businesses were able to see what the disease actually was and to see what kind of risk mitigation they could put in place, then workers were able to go back to their jobs. And so a lot of that has happened, and I expect that to continue to happen as we go through the rest of 2020. Next slide, please. So here's another chart that shows you how different this shock is from the previous shock, 2007 to 2009. This chart goes all the way back to January 2006 and comes up to the present on the right-hand side. The gray areas are periods of business recession. The gold line is the official unemployment rate. The dotted blue line is those workers who are unemployed but describe themselves as being on temporary layoff, and that's on the right scale. So if you look at the period right after the last recession, you can see unemployment, the gold line peaking at 10% on the left scale there. And then you can look down at the blue line and you see that those describing themselves as on temporary layoff at that point, only about 10% or 15%. So that blue line doesn't move very much most of the time. Most of the time, most unemployed workers will say that they're unemployed because the factory shut down or the business shut down. Their job is gone and they're going to have to find some other job. They're on so-called permanent layoff. But look at what happens during this shock here over on the right-hand side of this picture, the gray area there. Unemployment, of course, skyrockets when the pandemic hits, but the blue line skyrockets in tandem with the gold line. This is because a very large fraction of workers were describing themselves as on temporary layoff. At one point, as much as 80% on the right scale there were describing themselves as being on temporary layoff. Now it's down somewhat to about 45%. So again, it makes complete sense. We're using the unemployment insurance program, and we would expect to see workers that are on temporary layoff to be able, some of them to be able to come back into work as we learn more about the disease and as the pandemic rolls on here. So that has happened. And we still have a substantial fraction, 45% saying they're on temporary layoff is much higher than the 10 to 15%, which would be normal, which is the rest of this picture here from 2006 to 2019. You'd only have 10 to 15%. So you still got quite a ways to go here. And I'm going to do some calculations of that, I think, on the next slide here. So if you just thought that nothing else is going to change, but those that are self-identifying as being as on temporary layoff are simply recalled to work, then the official unemployment rate would decline all the way down to 4.6%. So you got a lot of room for downward movements in the unemployment rate in the months ahead here based on that kind of calculation. You might say, gee, Jim, that sounds too extreme. maybe the temporary layoff will just go, it won't go all the way to zero. It will just go back down to the 10 or 15% that's kind of normal among the unemployed. The 10 or 15% would describe themselves as on temporary layoff. And if that happens, unemployment rate would still decline to 5.2%. So numbers like 4.6% or 5.2% unemployment would be a very good outcome for this pandemic if we could get to that. And I think there's at least some hope that we could get there based on these temporary layoff considerations. So let's go to the next slide. So I've said that third quarter will be outsized U.S. GDP growth. So I'm just putting down some basic forecasts here that are available publicly in the market. I'll give the date here. These are September forecasts. One of the most up-to-date ones is the GDP Now that from the Atlanta Fed that people often track. And you can see they're all double digit, very high double digits. For those that follow macroeconomics, I'm sure you never expected to see a quarter where the annualized growth rate would be these kind of numbers that are in this third column here. Really, you know, close to 30% from IHS Markit or Atlanta Fed. I mean, it's just astounding, you know, the kind of growth rate that you're talking about there. Now, it all makes sense because you obviously had businesses closed down, and now they're coming back online safely. We all hope, and that's contributing to the rapid growth rate. I don't expect these kind of growth rates to continue, but I still expect way above normal growth in the fourth quarter of this year and first half of next year, and so on beyond that. So. You know, we've just got outsized growth going on in the third quarter here. Let's go to the next slide. So this very rapid third quarter GDP growth may put the U.S. economy within reach of a sort of full recovery by the end of 2020. If you look at what the average level of aggregate national income in 2019 was, you average across the 4 quarters of 2019, it was 19.1 trillion in inflation adjusted dollars. And again, this is the average level for 2019, not the peak level, which would have been in the fourth quarter of 2019. But let's just try to get to the average first and see if we can get back to that. You might be able to get there by the end of 2020 based on this very rapid growth that looks like it's going to materialize for the third quarter. GDP would have to grow 35% at an annual rate in the third quarter, and then you'd still need another 10% at an annual rate in the fourth quarter. So those are pretty big. They're a little bit outside of what even the optimistic forecasters are saying, but I wouldn't put it out of the realm of possibility that you could have the fourth quarter GDP close to or at the average for 2019. That would be a great outcome for the U.S. economy if we could get there. Let's go to the next slide. I just have one slide on mortality risk management. Those of you that have heard me before know I like to rant on about this, so let me just do the one slide on this. Next slide. We face a lot of mortality risk. I think the pandemic coming, you get the impression that you've never seen mortality risk before, but of course we do every day. I like to always cite accidental injury, which is the third leading cause of death, according to the mortality tables in the US. We do all kinds of things to try to prevent accidental injury, including airbags in cars and fire codes and all kinds of other things. Those have been developed over many, many years, centuries even. But here you've got a new mortality risk coming on the scene. But the same thing happens. Households and businesses develop strategies to handle the mortality risk as best they can. One of the most prevalent of these is just to use work from home, as we're doing right this moment. That's proven to be a viable and powerful strategy, and the U.S. has been in a great position where work from home is more feasible than it would be elsewhere around the world in many locations. And I also think for high contact industries that the essential retail services have shown the way. They've been able to conduct business with relatively low risk, and they've used available technology, very simple technology in most cases, and they took simple precautions, and they've been able to provide their goods and services as they had to because they were essential industries, but they were able to provide the goods and services in a relatively safe way that keeps their customers safe and their employees relatively safe. So I think what's happening during the third quarter and will continue to happen going forward is that many firms just adopt this strategy of using proven, simple risk mitigation activities. Masks are a great example, personal protective equipment, social distancing, very simple, very low cost methods, and the disease has not thrown us any curveballs so far. So those simple techniques have been pretty effective and will be even more effective going forward, in conjunction with better therapeutics and in conjunction with those citizens that are most at risk being very, very careful about any exposure to COVID-19. So I think that's basically what's going on. Let's go to the next slide. So monetary and fiscal policy have been also very effective, and I'm running a little longer than I meant to here, but we will get to questions in just a minute. Let's go to the next slide here. So I think monetary policy included lowering the policy rate to the effective lower bound. We also provided liquidity to financial markets through these lending programs. I think that our backstop lending programs stemmed an incipient financial crisis, and I'll show you the chart here in just a second. Let's go to the next slide. Here's the St. Louis Fed's Financial Stress Index. There are many measures of this. There are others around. Of course, ours, we think, is the best, so you should look at the St. Louis Fed's, but 0 would mean kind of normal levels of financial stress. A large positive number would mean very high levels of financial stress. And you can see that it was hovering around normal levels in 2018, 2019, January 2020. Then you get to the crisis in February, March, April, and the stress ratchets up almost to the level of 2008. So I would say that was an incipient financial crisis. The Fed comes in jointly with the Treasury, announces backstop lending programs, and financial stress went back to where it is today, which is near the kinds of levels that you would have observed pre-pandemic. So I think these programs have been really, really successful in keeping us out of a financial panic that could have occurred on top of the pandemic, but has not occurred, at least not so far. Let's go to the next slide. Fiscal policy included the CARES Act along with additional legislation. CARES Act is often valued at $2.3 trillion. Other legislation, you might value it at about $850 billion. The total would be about 14.5% of US nominal GDP in the fourth quarter of 2019. So what's happening is there were no taxes in there as far as I know of. So you're borrowing 14.5% of GDP, or at least you're authorized to borrow 14.5% of GDP by bipartisan agreement, but in the Congress, shocking, despite our dysfunctional politics, we have bipartisan agreement, recognition of the crisis, and a very large package here. Now, what's happened subsequently, I think this was calibrated to a bigger shock, because what's actually happening is that the actual shortfall in US real GDP in 2020, according to many forecasters, will be more like 3 or 4% of GDP. So that means household income will be down 3 or 4% compared to what it was in 2019. And so in an aggregate sense, there's considerable resources pledged already to fill that 3 to 4% hole that we have. Now, I understand that not all the aid goes to the right people, and people may be disrupted, businesses are disrupted that through no fault of their own, frankly, and then the resources don't flow to them because it's a big chaotic country and you've got all kinds of things going on. And I think that's a very legitimate thing, and members of Congress are keenly aware of this because their constituents come and tell them about it. But in a macro, I'm the macro guy, so in a macroeconomic sense, it seems like we've got enough borrowing authority to cover what we need to, at least for 2020. Again, going forward, I do not have a second wave in my baseline case, so I'm not assuming any second wave. But if a second wave occurred, then you could pass a new package that would do more, and you'd have to calibrate that package appropriately for the size of the disturbance that you think would occur. But as I said early on here, I'm not really expecting that as a baseline case. I think there's a lot of information about this disease, and we have a lot of information about how we can control it and mitigate its effects and still produce goods and services at the same level that we produced them in the past. So one of the things about this fiscal response that was so outsized is that it drove personal income up to an all-time high in the second quarter, the opposite of normal recession dynamics, and I have a picture of that. Next slide, please. So on this slide, on the left-hand side, we've got the dynamics around the 2007 to 2009 recession. Blue line is GDP and just nominal GDP, and the gold line is personal income, what households actually have. And you can see when national income goes down, then personal income goes down, and that's exactly what you would expect the recession dynamic to be. And then it takes quite a while to recover, both nominal GDP and personal income. But if you go to the right-hand chart here, which is the current situation, blue line is nominal GDP, gold line is personal income. Wait a minute, personal income did not fall during the recession the same way that it does in a normal recessionary dynamics, because the fiscal package was so big that personal income was actually higher than national income in the second quarter. So this is a sign that the fiscal response has been outstanding in this particular recession compared to how we've behaved in the past. Let's go to the next slide. All right, let's conclude, and then I'll open it up to questions. My points are that I think the global health response has managed to contain the pandemic in terms of health outcomes relative to the March-April peak. The second half of 2020 is a period of continued learning and adaptation to the new mortality risk in the economy. I think simple mortality risk mitigation strategies hold the promise of delivering both higher household incomes along with lower fatalities from COVID-19. So we're going to get better on both dimensions, better economy, better health outcomes. Downside risk, of course, remains substantial. Things can go wrong. We're in the middle of a big crisis. So continued execution of a granular risk-based health policy will be critical in the months ahead. So thanks for listening, and I'm looking forward to your questions.
Well, thank you for those insightful remarks, President Bullard. And just as a reminder, the replay and the slides will be available on a GIC website link later today. And now we'll go to our audience Q&A. I would like to remind our attendees that you can enter your questions through the Q&A button on your webinar dashboard. Please use the Q&A box rather than the raise hand feature with this webinar. So as a first question, President Bullard, maybe I could ask about the individuals who have left the labor force. There was a good discussion of the temporary employment situation, temporary unemployment situation that could come back. What about those who have left the labor force? If they do not come back, would we really consider the unemployment rate falling as described to be a measure of maximum employment if the participation rate is not back to where it was?
Yeah, well, there are many dimensions on which you can measure labor market performance, and one of the things that happened after the last crisis was that we started to measure things in a variety of ways. And so you could look at labor force participation, which plummeted in 2007 to 2009, but was subsequently rebuilding. I mean, it's a tough thing because you're asking people, okay, do you have a job? And they're saying, no, I do not have a job. And then you're asking them, are you searching for work? And they're saying no. So, okay, well, some people really are choosing to be out of the labor force. Other people are kind of saying that they're not really looking for work, but they wouldn't mind if they had a job. So I think all those subtleties about measuring labor markets are certainly just as salient today as they were after the last crisis. And we'd like to be good on all these dimensions, but the typical dimension that we look at is unemployment.
As the next question, maybe we could talk about consumer confidence, which seems to have been a little slower to recover than retail sales or some of the other metrics, which have benefited from some of the income transfers. There's some evidence that the consumer confidence numbers are affected particularly by consumer confidence of higher income individuals, which remains depressed. And that makes some sense if the service part of the economy is still impaired. Does that unique mix of what's gone on where goods seem to work and services are still impaired affect the outlook going forward? Or is the assumption that if we have a medical solution to the medical problem, that that's really our pathway forward altogether?
Yeah, I think that services don't look as very attractive. I guess high contact services don't look very attractive. Of course, during the pandemic, goods look more attractive. So you'd expect people to substitute away from services and toward goods. That's exactly what's happening on many dimensions. And, the speed at which this will recover on the service side, they've been hit very hard. Some of those industries have been hit very hard. They're really going to have to work to restore trust in their product and their service. I would say that there are a couple things that are developing that will continue to develop here. One is rapid fire testing, I think, where you could test people very quickly and easily. That kind of thing would really help airlines, for instance, or intimate restaurants or something like that. Someplace where you would otherwise be worried about the danger of contagion. You can really make sure that you're mitigating the risk aggressively. You've got other things going on. They can change the way they deliver the business. They can provide other reassurance. Other kinds of testing which aren't as invasive, like taking people's temperatures and just asking them about their general health or their general exposure, getting them to a test. A lot of companies are doing things like that. So all that kind of testing, I think, is critical and remains critical. We'd like simple, easy testing so that we can know exactly where the virus is at all times.
And so to follow up, it sounds like the medical solution doesn't have to be a vaccine. It could be a test or a therapeutic or some other method that allows the economy to function alongside the virus until there's a vaccine. Is that fair?
Yeah, and I actually think even if we don't get a vaccine, what will happen is that the entire economy will simply adjust to the new mortality risk, and they will use any and all of the things that we just mentioned in order to mitigate risk, and they'll drive that risk right down to to the lowest level that it can get to. I don't think you can get it all the way to zero. You do have some transmission occurring in, I think, family situations, other situations that are maybe not going to be amenable to fixing, but you can go a long ways, I think.
And we have one question coming in from the audience asking, you believe that the private sector will move this along in good fashion? Just to clarify that these things will happen and are happening from your business contacts and will continue to happen through private sector activity, the private business adapting to what needs to be done. Is that correct?
Yep, that's exactly what I'm thinking. Plus, you've got work from home. So work from home is one of the most powerful tools that we have. And if the pandemic continues to linger on, we can just continue to use that. Now, that doesn't help people that are in these high contact places, but I think they are also going to be able to adjust here. And even those that are the most stressed and the most affected, I think even they will be able to continue to make adjustments to get their product back on an even keel.
We have another question related here, which is, have you seen any difference in your contact with business between the agricultural and rural economies in your district or elsewhere versus the urban areas? And does that play into the forecast at all?
Yeah, I mean, I think that rural areas, they have had some transmission. A few areas haven't been careful enough, in some cases. But I would say overall that this is a story about closely packed people in urban areas. I think that's why Europe has had a tougher time with a lot of public transportation that makes things much harder to handle. New York and New Jersey had a tough time. So I think it's not that it doesn't cause problems in other areas, because it does, but I think those problems get compounded in high density places, and so those people there in those areas really have the tougher challenge here.
And in terms of how it might relate to the banking system, is there any sense in which the large banks which do stress tests are in one bucket, but some of the small and medium banks which may serve different communities are in a different bucket? And is that factoring into any of the considerations going forward?
You know, so far I'm optimistic on the banking sector. I know that markets are nervous that another shoe's going to drop and they're going to have a lot of bad credit out there, and they have reserved for that. But really, on the whole, I would say we've got pretty good news, pretty stable out of the banking sector so far. The banks that we have close contact with here in the 8th District. And I'm expecting them to actually come out of this pretty well based on my forecast. So far so good, I guess, is what I would say about that. Of course, they get paid to worry, and they are worrying, but so far so good.
So maybe to switch over to some of the concerns and the downside risk part of the discussion, if there is a second wave or if there is reason for additional concern, the question becomes, what tools does the Fed have? And there's been discussions of things like negative interest rates or expanding the balance sheet. Are there still tools that can be used if necessary?
Yeah, I think as always, the central bank has more tools than you think. I guess has been the lesson the last 15 years. But we could do more if it was necessary on these lending programs, which have proven to be quite powerful. I think we've got an excellent monetary policy in place right now, with rates low and expected to remain low for the foreseeable future. We've got our QE program, which we're buying at a rapid pace and continuing that. So we've got a lot of good pieces in place here. We could make adjustments to that, but I think we're in great shape for right now.
Is there any concern that if the Fed needed to do more, it would be moving to more of a fiscal policy area, that there's been support provided for certain sectors of the economy, whether it's munis or corporates, and that's really a new phenomena, and I think it has people wondering if we're crossing some sort of line or not?
The Fed was founded to prevent financial panics, and this was a case where the Fed prevented a financial panic. Wow, what a great you have a federal agency that did exactly what it was supposed to do. So I think that part has been very successful. And it's true that we're in these markets that we probably wouldn't have been in the past, but we're in as backstop buyers. We're trying to prevent the freezing up of those markets. We're not really trying to affect ordinary market pricing in those markets, and we're trying to stay out of that and let the market work. And so to the extent I know people are arguing about this, but I would argue that we're basically allowing markets to work at market prices. We're allowing capital to be allocated at market prices. That's what we want. We are there as a backstop. And so if things really got frozen in this market, then we would be the buyer. And that's the spirit of the kinds of interventions that we've done. Now, some of the economists in the audience will say, well, that probably does affect the market pricing slightly, but I think that's only a small impact on the market pricing. By and large, we're letting markets operate, but we're standing ready if we got into a financial panic kind of situation.
So given the improvement in financial conditions, then, if we were to see another fiscal stimulus and it were sizable, would you start to have concerns perhaps about longer run inflation or some other dislocation of that sort?
Yeah, I mean, you guys probably can read the politics better than I can, but you know, it's not clear to me what's going to happen. But some people seem to be saying that there could be a package in the first quarter of next year, and maybe it would be a sizable package on top of what's already been done. So that would add even more to the deficits that we've had. I think from our perspective, the monetary policy perspective, I think this puts a little more weight on the idea that inflation would be higher in the future than what we've been used to during, let's say, 2010 to 2020. During that decade, we had very quiescent inflation. It was very hard for the Fed to get inflation up to 2%. But if you're going to have outsized deficits, a rapidly growing economy, as I've argued in this talk, and the central bank not being as aggressive or as preemptive as previously, those things seem to add up to probably more inflation than what we've observed in the last decade. That's why I think we'll be able to get up above 2%, even 2.5% inflation in the years ahead here.
And in terms of describing the risks, then it sounds like you have downside risks and perhaps upside risks if we were to get into an inflationary scenario. The downside risks seem concentrated on policies that have been put in place being removed too early. So if you had unemployment insurance and there was additional concern it was removed, are you concerned about things like state and local government aid, or let's say the aid to small business on the downside? Are those particular risks, or is this a general market functioning story that worries you the most?
You know, I think there are concerns, and these are matters for the Congress to deal with, but there certainly are small businesses, absolutely, that get hit very hard and can't get enough resources to make their way through here. I think, you know, that's a concern. So many in Congress have called for more of the PPP program, which is considered to be very successful here. I think individual people that have been laid off, you know, you're asking them to not go to work because you don't want them to spread the disease. That's a situation where you definitely want to be able to compensate that person until you find a way to work safely. So I think you have to make some judgment about whether we have ways to work safely in their particular job or not. Some of them don't, some of them do. Very tough issues, but these are really questions of direct fiscal policy that have to be answered by the Congress and the states. Of course, the states are always going to come to the federal government and want the federal government to borrow on their behalf. So I'm not surprised that you're seeing a lot of lobbying in that direction.
And then on the other side, if there's the upside surprise, would we worry about bubbles, which has been a concern perhaps in asset prices, but are conditions allowing that if we have low interest rates for multiple years ahead?
Yeah, I mean, it's been a concern since Alan Greenspan's irrational exuberance speech in 1996. And I think ongoing theme in financial markets has been bubbles of various kinds. The two previous recessions were arguably caused by the bursting of financial asset bubbles, the dot-com bubble in 2001 and the housing bubble in 2007, before 2007 and 2009. So it remains very salient, but I don't see financial risk on that scale right now. People could argue about it and always do, but I'm not seeing that as being the key concern right at this moment.
We've had a number of questions come in asking about the November elections and will that impact the forecast. So maybe I could just ask it as not so much is there an opinion on which way the election will go, but would you see your forecast at the beginning of next year having abnormal volatility because of the election? In other words, you may have to revise it one way or the other more so than you have in the past based on these interplays between monetary and fiscal policy.
Well, I guess my argument is that despite the dysfunctional politics, we actually got a very good fiscal outcome back in March, April. The pandemic came upon us. It was recognized by everybody, and they put a package together, and it was a pretty big package, and it was calibrated for an even bigger shock than the one that we've had. So, you know, from that perspective, I guess what I would say, and given my forecast, which I'm more optimistic probably than most, but given my forecast and given what's already happened, I kind of feel like we're over the hump on fiscal policy. You could always do more. You could always do something targeted. There are certainly pockets that could be helped, and you probably will see some kind of bill at some point on that, but it may be into next year before you see that.
Then maybe as a final question, if I could ask, we've talked about some of the productivity enhancements as companies have adapted to this environment. Would you see those productivity growth numbers continuing? Things like tech that are now used more broadly because they had to be, could have a boost to productivity growth, not just a one-time lift. Is that a reasonable approach, or is it premature to think about productivity having a change in trend?
Yeah, I mean, talk about your silver lining. You're really forcing people to get into mobile technology even more than they were before, and using it for all kinds of things that they would have otherwise taken 4 or 5 years to get up to speed on. So I think that kind of innovation is absolutely what comes out of a crisis, and some of those will manifest themselves in longer-term productivity gains. And that'll be a great thing. So hopefully we can get some of that to happen. One of the most famous examples is radar coming out of World War II. You know, if the war hadn't come along, you know, it probably would have been a long time before that was developed, and it found uses even in peacetime. So I think that is a silver lining, and hopefully we'll get those productivity improvements that we've been looking for in the last 5 to 10 years.
Well, President Bullard, thank you for a fascinating discussion and for spending time with our GIC community. We hope to see you for a GIC program again soon. Until then, please be safe. For the audience, before we close, GIC is excited to announce that our next executive briefing on Thursday, October 6th, will focus on COVID's effect on artificial intelligence and machine learning. We're delighted to be joined by Patrick Harker, the President and CEO of the Federal Reserve Bank of Philadelphia, Greg Driscoll of Penn Mutual Asset Management Company, and John Donahue of Penn Medicine. Registration will be available later today on the GIC website. As a reminder again, today's webcast and replays of all past episodes of the executive briefings are available on the GIC website. To find the replays, explore GIC membership, please go to www.interdependence.org. As we conclude, we encourage you to take 60 seconds to respond to our audience survey. Your feedback is important to us, and we appreciate you letting us know how we can improve our programming. Thank you for your attention, and have a good afternoon.